This month, I had 2 clients close, where the first one saved $350 a month. The second one saved $528 a month. The option I set them up with is called a temporary interest rate buydown, most commonly known as a 2-1 buydown. In this video, we're going to talk about what is a temporary interest rate buydown, who it makes most sense for, why your money is most likely better used in this market with a temporary interest rate buydown, and in the end, we're going to go over a pro tip, so stick around for that. I want to make sure your mortgage experience is easy, and the pro tip will help you get there. My name is Dan Friel. I work with Barrett Financial Group, and we have over 160 different lenders and hundreds of options, and this is just one of them. So let's cut to it. So this is my loan system. Let's go over what a 2-1 temporary buydown is. We're just going to do a purchase price of $450. A 3% down payment is available for first-time home buyers on a conventional loan. And then for the interest rate, let's just make it super easy and digestible. We're going to do 6%. Okay, so we'll hit save. And I have estimated homeowners insurance and property taxes and mortgage insurance for, let's call it Arizona. So your costs may differ depending on the state, but if I select what a temporary interest rate buydown of a 2-1, seller paid, let's see what that looks like. So monthly savings, let's just start here. For year one, you'll save $533 a month. For year two, you'll save $273 a month. And that's because the interest rate for year one is 4%, year two is 5%, but then your note rate or your qualifying rate is 6%. And the amount of money that is needed to fund that, if the seller wants to pay for it, in most cases it makes the most sense if the seller pays for it, is almost $9,700, so a little over 2%. So in this instance, you're going to have to ask for 2.2 to 3% of a seller credit to get this thing to work. Now, why is a temporary buydown more beneficial than a permanent buydown in some cases? So a permanent buydown is when you just buy the interest rate down. Let's say for $9,700, you can get a 5.5%. Saves you a little under $200 a month, right? And that's for the life of the loan, so 30 years. But if you refinance the next year or 2 years, you paid $9,700 for $200 a month. And the turnaround time for that, so the break-even point, $9,700 in cost, divided by $200 a month, it's going to take you 48 months, which is a little over 4 years. In this market, it's December 2024. We all think rates are going to start sliding down. They've already started to a little bit in the next 12 months to 24 months. So you're probably not going to make it to your break-even point if rates go down and you want to refi. So if you do a temporary buydown, in this instance, the 2-1 buydown, and let's say for the first year, you're saving that $500 and something a month because you have that dreamy 4% interest rate. And then all of a sudden rates plummet and you want to refi. And you have half of the account left of that $9,700. So let's say you have $5,000 left in the account for the following year. That difference, or the amount that you have in that account to pay for your temporary buydown, when you refi, gets applied directly towards your principal amount, so you don't lose it. So unlike a permanent rate buydown, where you have to wait 4 years just to break even on the cost of that rate, a temporary buydown, you can get your money back towards your principal, and there you go. You're on your merry way. So in this market, 9 times out of 10, a temporary buydown's better use of your money. It stretches your dollar farther, so you don't have to worry about, am I going to have to refi? Is there a risk? Is it a gamble? Because in this case, it's not. You get the benefit of the lower monthly payment paid by the seller, and then you get the difference in if you haven't used up that account yet and when you refi towards your principal balance. So what are the different types of temporary buydowns? Let's jump into it. So if I go to my drop down here, there's a whole bunch, but there's really 3 that most people do. So there's a 1-0 buydown. We can click on that, quickly price that out. It's a lot cheaper because you're only paying for 1 year. Your interest rate drops 1% for the first year, saves you $273 a month. This is a great option for people who the seller won't give them the full 2 or 3% seller credit. So you can ask for basically a percent, a couple grand. Most of the time they'll accept that, help fund this temporary buy down. We already went over the 2-1 buy down, which again looks like this. There we go, it updated. Okay, $533 for the first year is your monthly savings. $273 for the second year is your monthly savings. And then there's another option where it's less common because it costs so darn much, is a 3-2-1 buy down. So yeah, if you're following along, the first year is 3% lower than the note rate or the qualifying rate, so 3%. Then it's a 2% drop and then a 1% drop, then it's your note rate. In this case, it saves you $776 for the first year. That's your monthly savings. $533 a month for the second year, and then $273 a month for the third year. And this is your annual monthly savings if you want to check that out. But the total buy down cost is over 4%. So in this instance, with this down payment, it's not going to be possible for a conventional loan because there's limits on how much the seller can assist or the amount of seller credit that they can give you. But if it's an FHA loan, you could ask for 4.5%. You could ask up to 6% of a seller assist or a seller credit and help pay for something like this, which I have seen in this market. But there you go. Main three options when it comes to temporary buy downs are 1-0 buy down, 2-1 buy downs, 3-2-1 buy downs. And that's really it. The main benefit, if we just summarize real quick, of a temporary buy down is it lowers your interest rate for how many years that you choose for the buy down, most likely funded by the seller. And if you have any money left over that hasn't funded those years yet, if you refinance or sell before the first couple years are done, then you get it credited towards your principal amount. Versus a permanent buy down where you just pay money for the lower interest rate and you do the break-even analysis of, okay, it's going to take me this many years to break even on this investment for my home. So when rates are high like they are now and expected to decrease, temporary buy downs are the bread and butter. When rates are really low, if you're timing the bottom of the market, which good luck doing, but a few years ago when rates were 2 or 3%, a lot of people just threw money at permanent buy downs because they were the lowest rates in history. That's when that made more sense. But in reality, you can't go wrong with either, just depends on your specific scenario. Oh, and one thing, let's go over the pro tip I wanted to go over. Pro tip is when you are thinking about buying a home and you get pre-qualified, you're a few months away, let's say 3 months before you actually want to buy, take all your down payment money, all your cash to close money, transfer it and put it in a bank account, and don't touch that bank account for over 3 months. Because when your lender asks for your proof of funds to close, which is 2 months of bank statements, you can go ahead and say, hey, here's this account that has no activity, and they will get those documents, it'll check out, and there'll be no questions asked, and that will be done and off your plate. If you do that during the process, or right before the process, you transfer large sums of money around, there are large deposits that need to be sourced. And the rule of thumb is anything over 50% of your monthly income has to be sourced by law. So if you make $5,000 a month before taxes and there's a transfer or a deposit that's $2,500 or more, the sourcing has to take place on that. So where to come from. If it was a sale, please give me the receipts. If it's an account, please give me the bank statements for that account for the source to show it coming out. And if there's other large deposits in that, those have to be sourced and it can become a headache. So in the end, if you are planning on buying a home, put the money in an account that has very little activity many, many months before you close, ideally 3. And that way your funds to close will be set, and then that conditional will be, here's my bank statements, and that condition goes off the table, and you don't get stuck in the never-ending sourcing before closing. So that's really it. We went over what a temporary buy down is, what the different types of temporary buy downs are, why it's different from a permanent interest rate buy down, and then why, for the pro tip, putting money in account, getting ready multiple months before you actually go to buy a home will make your mortgage process super easy. My name's Dan Friel. If you have any questions, stick them below in the comments. I will be sure to answer them. I'm here to help. I want to make your mortgage process very, very easy. And that's all I got for you today. Take care.